السلام عليكم ورحمة الله وبركاته. We welcome you today for the MSM Investor Discussions, and today we are presenting our first half 2022 results to you. So I will start the presentation, which is comprises of, to start with, we'll provide the company's overview and key strategic initiative for 2022. Then we'll provide the financial performance, discuss the financial performance for the H1 2022. And last, we'll talk about the comparative analysis of us with our competitors. Company overview, United Finance established in 1997, and we operate within the Sultanate of Oman and provide financing for retail and corporate customers mainly. We are a listed company in Muscat Security Exchange since July 2002, and currently our market share is 9%. We have our head office in Muscat, and we employ 138 staff with Omanizations of over 84%. Our major key shareholders are four key shareholders. We have Oman Hotels with 34%, Global Finance Investments with 25%, S.A.O.G company through Ubar Financial Investments 8%, and OHI on about 5% of our shares. The key product that we offer for retail, provide financing for new and pre-owned vehicle, and we provide financing for consumer durables. For corporates and SMEs, we have four products on the lending side: equipment finance, we provide working capital finance, sell and lease back with solutions for refinancing existing assets, and we provide as well a debt factoring solutions. On corporate side, we offer deposit products which are flexible and good higher return compared to the banking sector. So our network of UFC, we have 8 branches across Oman, the head office, plus in each region, Ibri, 1 branch, Sohar, 1 branch, Barka, we are in Mawaleh, we're in Ibra, Nezwa, and Salala. Currently, we have 10,000 active customers, and as I said before, we have around 130 plus employees with Omanization of 84%. So on the governance perspective, our chairman, Mohammed Fonji, deputy chairman, Hassan Ahsan Nasib, we have Hissam Basami is represent global, Fred Fariboz Faisali represent Oman Hotels, and then we have 3 independent directors, Wasim, Salman, and Mohammed. All the board members have extensive business experience and have been board of various companies, and they give us tremendous support to execute our strategy. The management team, I joined UFC in September 2021, and in the last 1 year today, we have invested in the senior management team with 3 Omanis join myself. Abdulaziz Mehrazi is Chief Operating Officer. He comes from NBO and have over 21 years experience. Fawaz Ariyami as Chief Business Officer with over 15 years experience in the banking sector. Abdulaziz Al Abdusalam is our Chief Transformation Officer, who is in charge of our strategy, transformation, and performance management with over 18 years experience in the banking sector. Then Mahmoud Al Hadi is our IGM Retail. Nanda Kumar, IGM Risk. Our Head of Finance, Debraj Manji. Onkar Gopal, our Head of Audit, and recently joined Mai Salamki as our Head of Compliance. All the management team is a new team. We have 5 new teams among the 9 joined UFC, to revise and transform the UFC in line with the strategy that has been agreed with the board. At a high level, our strategic intent is in 5 points. First one, which is far the most important, is bringing the customer first, and which means our processes and our product should be meeting the expectation of our customers and going over and beyond in attracting new customers and growing the existing one. From the business growth, our focus is on the quality of the portfolio, and in the last 1 year, we had a strategic shift to retail segment and selective corporates. And we'll come later on when we talk about the financials on how the portfolio mix have changed from last year to this year. Our key intent is the execution of speed. So we have streamlined the processes, and we are currently in the verge of agreeing on large investment in technology that will bring us apart in offering digital services and being closer to the customer. From collection and recovery side, it's continue to enhance the effectiveness and maintain the provision on the low level and collect the old bad loans that we hold in our book. At the foundation of our strategy is our people, the staff our staff in the company. So we have embarked in extensive strategic staff development plan with training and job rotation for the staff, as well as in the current year, we have identified a pool of talent with Omanis within the USA, and we are doing a big investment to make sure that we provide them with the training and coaching so they can be able to take over higher positions. So our strategy has 5 core focus. The first one, as I mentioned, mentioned before, is on our people. So we have a new executive team with about myself 1 year and the other team 6 to 3 months, which have joined me in implementing the strategy that has been agreed with the board. We have enhanced our performance management framework, internal communication, and added coaching and mentoring for our staff, and introduced employee motivations program, as well as the investment that we are doing on the training. The second focus is the processes, streamlining the process and being able to respond faster to the customer. So our loan origination process has been revamped. The customer touch point we reviewed, resolution management. We have automated certain processes. There are more to come, and we are reviewing a document management solutions, so we can, over a period of time, we can be a paperless office and company. The system, as I mentioned, we are in the verge of agreeing on major investment in the system. That will bring us at a higher level and offering digital products and being closer to the customer, as well as it will enable us to be a paperless company, provide the customer with seamless experience and convenience, offering digital products, content management solutions, and the system will be able to help us in introducing new products for our customer. From the financial perspective and customer, the focus is in growing the company again, and we'll come back when we look at the financial numbers, how we have done in the last 1 year. We focus on new product developments, fee income. At the strategic level, we have changed the focus to the risk, retail segments, de-risk the existing corporate portfolio, and selectively onboard new quality corporate assets. We also have introduced at the last quarter a funding strategy to enable us to reduce our cost of fund and also enhance our net yield on the loan portfolio. Dealer relationship for the retail side is paramount for our strategy. So we have enhanced the relationship with the dealer as well as with the second-hand cars market dealers along all over the Sultanate of Oman. The collections and recovery is a key focus and will continue to be a key focus for the organizations. So on that, we have reorganized the team to focus on collection recovery and already seen results in reducing the NPL. We have daily reviews with the team, and at the beginning, we have set this right strategy that will enable us to enhance our bottom line. We are also looking at the branch network, given that for a couple of years we haven't had any investments. So we are looking at the branch relocations and refurbishments. At the moment, we have 2 branches, refurbishment and relocation going, one in Ibri and Salalah. And in the coming year, we look at other branches. We are in process of setting up a marketing hub, 1 or 2 people in closer to the customer and closer to the relationship, the dealer relationship that we have. In the last 12 months, we also look at bringing new blood, new branch managers and new marketing people to our branches. That will enable us to enhance the performance and bringing new energy in the branches. And we have upgraded our branch connectivities already. So in performance, financial performance that we have, I'll give an overview of how we have done in H1. From the profit and loss accounts, our operating profits was 1.28 million, net profit 766,000, and it's 689,000 with prior year expenses that have been accounted for this year. The balance sheet, our net debtor increased to 82.4 from 80.3. So we are growing now again the company. We have a very strong equity base of 46.9 million. Our borrowing is under 35 million, giving us a leverage for our company of just 0.9 compared to the competition where they are leveraged at 2.5 and more. Our loan loss coverage, provision coverage is closer to 80%. And we are pleased to say that we are the second highest after Al Omania. And in the first half, we added the ECL provision of 380,000. Next. How does it compare to last year, 2021? Our net income grew 18%. Our fee income grew by 15%. The operating income overall grew by 17%. Our ECL was 380,000 compared to over 1 million in H1 2021. And overall, we have 993,000 riyals additional general provision on the deferment book. So we closed the half year with a profit of 889,000. Without the prior expenses, we would have been at 766,000, which compared to just 41,000 in H1 2021. Our return on equity increased from 0.18% to 2.9%. And our going forward, that is a key focus: bring profitability, enable stability in the profitability of the company, and enhance return on asset and return on equity. So for the coming to details of how we have done this year, I'll pass the floor to my CFO, who will come talk to us in much more details on the performance. Go ahead, Dilraj.
Thank you, Mr. CEO. Taking it forward, after the brief presentation of the financial numbers, here we are, the little details and the year-on-year growth on our financial income and other elements of the profit and loss account. To begin with the finance income, we have grown 6% over the last year. Last year, H1 number was 3.5 million, and we are closing at 3.7 in this H1 22. So we see a 6% growth over the previous year number. If we talk about the net income, we've grown by 18%. We have closed half yearly at 2.93 million real compared to 2.49 in the last year in a similar period. Net income is comprised of both finance income as well as our interest cost, borrowing cost. As Mr. CEO was referring earlier in a funding management in the key focus area, we are continuously engaged with the bank, continuously improving our relationship with bank, strong relationship already we have. We have managed to reduce our funding cost in this H1 this year compared to previous year. If I give a small number throw, our funding cost was hovering around 5.7% at the end of 2021, whereas we are at 5.04% in this H1. So we see an increasing amount of the spread on year-on-year basis. Going to the next, our other income mainly consists of the fees income, which has been grown by 15%. So we have closed our books as 218,000 compared to 190,000 in the last year. If you look at the operating expenses, we have grown 18% compared to previous year. This is mainly because of some key strategic initiative we have taken in the investment in the technology and the transformation, which resulted in the increase in this percentage. But we expect a good amount of return in over the years, coming years. That will benefit us to save the cost as well as improve the bottom line in coming years. If we look at the key area of our operating profit, which has been grown by 17%. Previous year, in the same period, we closed at 1.09, where we are at 1.28 million at this year. We see an increasing trend over 2020, where we had 2.4. From there onwards, we are moving ahead. And we'll keep continue going forward to improve the operating profit as well as net profit. Coming back to the net profit, we have recorded 766,000 real of profit without the prior expenses. With prior expenses, which is reported in the market, is 689,000. Similar period previous year, we have recorded 41,000 Omani riyal. So we see a good amount of increase over the net profit over the last year. If we see the earlier years, we are in the growing phase of increasing our net profit, and inshallah will improve this further to this 2022. If we look at the balance sheet, I like to draw your attention on one of the key area for our installment finance debtors. In 2021 H1, our books stood at 76.3 million, whereas we end the year 2021 at 80.3 million. And now in this year, in half yearly, we close at 82.4 million. So we see a growth over 76 to 82 million, a 6 million growth we have seen over the last 1 year. And we expect this growth will continue further by this year end as well as in going forward. But assuming one of the key focus what Mr. CEO has just explained, to improve the quality of asset. And we'll see another slide down this, where the strategical approach has been changed on the business segment wise, but this will keep continue enhancing further without compromise, with having a good quality of product into our book. Now, I'd like to draw your attention in the next slides, how our loan book comprises of. In 2021, in H1, our corporate used to have a 62% composition and 38% is a retail. So on an average, 60% was our corporate, 40% was our retail. But now, with the changing, with the direction by the board and with the management focus, we have changed that into the opposite side in this H1 2022, where retail we are having close to 60% and corporate we are having at 40%. So this is going to be a strategy for us to focus more on the corporate and to enhance the book with a good quality portfolio. If we look at the balance sheet, liability side of the balance sheet, we continue enhancing our equity part. 45.45 billion was our total equity in 2021 H1, whereas we have closed our books at 47.3 million, and we have declared a dividend of 3% in this year. And after adjustment of the dividend, we are at 46.9, almost 47 million of total equity by end of H1 2022. If you look at the loan book, bank borrowings, from 29.5 million, we have restricted to 27.9, and now we are at 31.9 million. Our corporate deposit was 3 million last year, but year end we are at 4 million, but now in this half yearly end, we are at 2.3 million. So this slight increase in the loan book is resulted due to repair of the high cost bearing corporate deposit, that to improve our funding cost in a lower level, we have repaid the high cost bearing FD, and that has been sources from the bank, as well as this is completely in correlation with the increase of our book size in the debtors. If we see ratios, we'll start with the leverage. As Mr. CEO was highlighting before, we have a leverage of 0.9%. We are one of the best in our FLC's industry. We have a very high potential to enhance, to enrich this area to increase our book size even to the double. Bank borrowing to the net worth, it's 72.59%. Our cost to income ratio is 55.8%. In general, our costs hover around 50 to 55%. As we have started investing in technology and transformation, we see a slight spike in this H1, but this will continue over the time. This will show a similar trend on 50 to 55% in that range. The next is our gross NPLs, which is 26.1%. In 2021, it was close to 27.3%. So we have improved our percentage of our NPL percentage from 26.3 at the year end. Now we are at 26.1. There are a couple of combination works here. The improvement in the NPL, at the same time, the book size also, and both we are able to achieve. We reduced our NPL in absolute terms in this year compared to the previous year as well as December, and also we have increased our gross book also. We have crossed 101 million of book size in this year. So this is a continuous focus for us to improve this gross NPL ratio further. But to add here, majority of our percentage, almost out of this NPL, 60 to 75% is because of the legacy and the old packages carry forward. So continuously in the current book, what you are going to add, we are not letting it slip into the other buckets. But because of the baggage and the legacy is carried forward, we see a higher percentage here in the gross NPL. If we see the next, the ECL coverage, which is a very, very important part, we are close to 80%. We are continuously improving this percentage. In 2019, we are at 73.9%. From there, we are gradually improving to 70% and 20. In 2021, we are at 78, and now at H1 22, we are almost 80%. And this will be our continuous focus area as well to improve this coverage area further by reducing the NPL and having a prudent approach as management as well as board has directed. So we are having a prudent approach on our provisioning policy, and improving the NPL also will enhance this percentage further. Return on equity, we are at 3.7% at H1 2022. We are very focused on this part. We like to go back to a double-digit return on equity. That's our management goal to achieve. To achieve our old days where we had a double-digit of return on equity, and we'll continuously focus on enhancing return on equity further. The staff expenses to the operating expenses is 61.3%. We are below the average in the market, and our organization ratio is well above our required percentage. We're at 84% organization ratio we carry at the end of H1 2022. The next couple of slides try to give the highlights in the positioning in terms of with the other peers group. If we see net debtors finance debtor comparison with other FLCs, we are at 82.4 million, whereas it is leading by National Finance by 420 million, and Tajik Finance and 180, Muscat Finance 101, and Alemania at 109. So we are having 9% market share in terms of net portfolio in FLC's market. If we look at the net profit point of view, UFC has made 689,000 after the prior year expenses adjustment, which is reported profits for half yearly. Muscat Finance has made 723,000 compared to 782. National Finance has made 5 million, Alemania 1.3, and Tajik has made 1.34 million in this H1. And our key focus to enhance the return on equity as well as to improve our profitability in going forward. So this is the end of our financial brief number presentation. And now we'll open the floor for the investor as well as the others to have any questions, and we'll be able to answer those.
Thank you, Debraj. Any question?
Hello.
Hello, yes, Mr. Michel.
Hi, good morning. This is Bishan Bhalla from Vision Asset Management. Thank you so much for this presentation. I just have a couple of questions to start off. If I could, I'm addressing this to the CFO. You mentioned your NPA number and the provision coverage. Could you just explain where did you get the NPA number for? What is the absolute number for this quarter, and where can we verify this number? Because there are a couple of numbers in your notes. One is the stage 3 loss, and one is the total number of sort of loans which fall under stage 3. So which number are you considering? If you could just explain it to us so we have this reference point going forward. Thank you.
The NPL stood at H1 2022 at 26.4 million in total, 26.4 million Omani Riyal.
Yes.
In 2020, we had 27.3 million, and in 2019, it was 26.8 million. So we see a growth in the terms of controlling the NPL number over the years. And this will keep continuing going forward as well, with a strategy in place for the improved collection in place, at the same time to increasing the quality of book as well.
Correct. Noted. Now we agree that the NPL number is 26.4 million, and I found that number. That's fine. Thank you for that. Could you explain what provision coverage number you've taken to find out the coverage ratio? Now, in my opinion, that would be the IFRS 9 number mentioned in your notes. Would that be correct?
Yes, that is true. This includes all our provisioning area, including our management overlay, our general provisions, and our general provisions as well. Everything is added together. So we are at 79.85%. In total provision.
Okay, because the provision as per IFRS, if I look at your notes, now there are two numbers. Now provision as per IFRS is 18,603. Is that correct?
Yes, that's true.
So that would give me a provision coverage ratio of 70.5%.
No, here we have a special reserve also is there at 2.3 million. So 18.6 plus 2.3, which translated to your 79.8%.
2.3. Sorry, could you repeat that 2.3 million number just for my understanding?
Yeah. I will explain the differences.
Thank you.
We have a provision under the IFRS 9 model.
Yes.
Which is about 18.6 million.
Correct.
Over and above that, we have a special reserve under CBO provisioning norm of 2.368 million. And we can look at our balance sheets in the equity side. Under the equity, you will see special reserve of 2.368. So we are holding on IFRS 18.2 and 18.6, and additionally we are holding 2.368 million provision. So if you look at the total, then our coverage is about just under 80%.
Excellent, understood.
So
yes, thank you for explaining.
Is we at the moment, as per the central bank, we are running a parallel run on provisioning under CBO and under IFRS. If you take under CBO, we are higher than under IFRS, and the difference is the 2.368 million.
Understood, and that's the difference you're allowed to sort of carry, even though you report the IFRS number. The excess basically goes to a special reserve. That's how it works.
Yes.
Okay.
So
okay, understood.
Until the CBO regulators decide to change completely to IFRS 9 provisioning norm, we'll continue to hold the additional special reserve.
So effectively, another way of looking at it is you take the greater between the CBO and the IFRS number and you divide that by the total stage 3, because the CBO number is 21.4 million. That's the difference of 2.3 million, I think, that you mentioned.
Yes.
Understood. That makes sense. Fine. Thank you. My next comment was on your net interest margin. Now, we've just done a basic comparison of the sector. We found that you rank among the best when it comes to net interest margin. What I've also noticed is that during the downturn, you've been able to pull back on your deposits. Now if I look at your gearing ratio, it is the lowest in the sector, and deposits have dropped significantly. Your deposits were, not mistaken, 57 million in 2018. They're all the way down to 33 million currently, 34 million. How do you see this deposit base going forward once opportunities come in the market? Because that would have some impact on your cost of funding as well going forward. If you could just comment on that.
Okay, our deposit was 4 million.
Total
our
borrowings
deposit was 4 million as of December 2021. And currently, as of June, is 2.35 million. So the deposit, if you look at the composition of our liability side, the deposit is about 11% only. We measure mainly depend on the borrowings. Our strategy when in the current year has been to reduce our overall cost of fund. And unfortunately, the deposit from the corporate customer comes at much higher rate, while we have existing banking line at a lower rate than that. So we have to manage the profitability of the company. So we moved from deposits to borrowing, and at the moment we have a liability strategy. However, the growth in the deposit will largely depend on the cost of the deposits. We will not be going for deposit just for the sake of going for deposit, but if it makes sense to our financial performance.
Okay. The next question is with regards to cost to income. It's currently among the highest in the sector. What is the target cost to income going forward in a normalized scenario?
So at the moment, our cost to income is at 55.8% for the current year. And just to mention, this current year, we have embarked in the strategic transformations of UFC. And that involves certain spending for this year. Going forward, this number will improve much more, and it will be a combination of two. Our overall cost will come down, and our income will go up.
Okay.
To add, I would like to add one line with this. That most of the nature of our cost, our regular cost, are in fixed in nature, more or less very less growth on that. So it's increase of the income, this percentage will further go down below 50%. The markets hovers around 46%. So with the increased amount of revenue, the income in coming days will reduce this percentage below 50%.
There'll be gradual reductions. As you see, we are very cautious on increasing our loan book, given the market scenario. So we have a clear strategy where we want to play and which customer we will embark in. So over a period of time, we'll see that our earning capacity increases, as it has been in the last 1 year. So if you look at the last year compared to this year, we have shown you the income growth overall, which has been 18% net income, and that has been a combination of growth in portfolio as well as the tight management of the cost of fund.
Okay, noted. My last question is with regards to ROE. You mentioned that the company is focused on improving its ROE for shareholders, and we take that point well. Given the current level, when do you think it would reach your aspirational target? By when do you think you would be able to achieve, say, 8 to 10 or 10, 12% ROEs?
See, we have revived strategically the company UFC, and we have a 5 years plan for enhancing both return on assets and return on equity. And as you know, we are just out of the COVID time, and the markets, the economy is still very tight in the market. So as the market improves and we put in place our investment, our strategical investment yield result, we'll see this number going up, inshallah.
Noted. My last question is with regards to dividend payment. There was a lack of dividends in the prior years. We saw dividends return last year. What's your thought on dividend and payout ratios going forward?
So this is the trick, because the dividend payout is largely depend on our regulator and also on our performance in the next half. So in the process of time, we'll inform the market of dividend payout. But as you see, this year is the first time we paid dividend. Last time dividend was paid was in 2017. So we are back in being a dividend paying company. We are investing in a company. We started seeing growth, and we start seeing a positive trend in all fronts, in income, in net profit, as well as in the portfolio quality and reduction in NPL. But the new management that has been appointed, working very hard to ensure that we come back to be one of the best FLCs in town.
Noted. So just one last question. This is with regards to the restructured book. That's something we've been looking actively at the entire financial sector, banking and leasing. We understand that the moratorium for the SME sector or the corporates ends on 30th September, as guided by CBO. How do you see restructured loans build up post that moratorium period, or are you done with most of your restructuring already? If you could just answer that question.
Okay. During the COVID period, our portfolio under COVID dispensation was about 22 million. Starting from last year, September, after I joined, we look at mainly the corporate borrowers. And those who are not affected, who have been affected by the COVID, we started pushing for repayments. So we have seen the repayment coming down. In the current year, our overall restructuring portfolio is under 900,000 real money, as compared to a much larger number in the sector as well as in the banking scenario. So the portfolio quality has been good. However, we'll continue to monitor very closely all the borrowing. Starting last quarter, we have implemented a new management committee, which oversees the whole portfolio and meets 4 times in a week. So we have a clear, high oversight on the portfolio quality as well as on the operation recovery. In addition to that, we are very, very prudent in the new lending. So in the question, our portfolio that has been restructured post-COVID is under 900,000 riyals. And against that, we are holding a special reserve on that portfolio.
So could you just clarify the 900,000 number? I am referring to the total restructured accounts as per your notes, and that shows 3.99 million. Could you just explain that? So
over a period of time, in the normal working of the company, we have customer who comes for restructured, and we see how to support. The 900,000 which I'm talking about is out of the 22 million portfolio that was under COVID dispensation, COVID deferral. Of that portfolio, the portfolio that has been restructured, which is impacted by the COVID, is under 900,000.
Okay, fine. All right. Thank you so much.
Thank you.
Good morning, gentlemen. My name is Abbas Muslimi. I work as a portfolio manager for Vision Asset Management. Thank you very much for the call, and really appreciate your time and your answers to all our queries. I just had a few questions. The first one is just a bit of a clarification, because when I look at last year's numbers, especially the fourth quarter, and if I look at the revenue, it doesn't sort of fit in with what sort of quarterly run rate that you've had. Suddenly there was a big spike in the fourth quarter when it came to the revenue side, which sort of didn't make sense to me, especially because it's ticking along on a quarterly run rate, and that it suddenly went from 1.8 million to 3 million, and now it's fallen back to 1.9 million on average in the first 2 quarters. Could you clarify what exactly happened in the fourth quarter of last year?
We had an element of RI in the last year, which is accounted on the fourth quarter only. Basically, that RI has resulted because of the collection made on account of NPL groups over the years previously, that we accumulated and recorded income on the last quarter. So we have added roughly around 958,000, to be more precise, in the revenue on the fourth quarter of the last year. So that's why you see a sudden spike, but we are pretty much in the same rate, the way it has been performed. In H1 last year, it was 3.5, and we are at 3.7 now. And we are very steady on this aspect, that will keep continuing enhancing our income further. So if you read the financing from a previous year, I would say if you eliminate that RI one of the kind of income, it was 7.3 million in total for the year of 2021. So keeping that in mind, 7.2, we have already made 3.7 in this half H1. So we'll enhance.
Okay, that's very clear. But from a YOY comparison point of view, is reserve interest, was it like a one-off thing that comes in the fourth quarter, that only came in the fourth quarter of last year, or is that something that you expect to sort of come in every fourth quarter? You see my point? Because from a YOY comparison point of view, let's say there is no reserve interest this year, and if you're looking at an organic sort of book, then it looks like your numbers are going to fall sharply from last year, thanks to no reserve interest being there. Is that a business phenomena that occurs every year?
This is one of the cases happening in 2021, and we have changed our accounting policy also. Now we are recording income on the basis of cash basis. So these things won't occur in near future as well. So one of the time happened in 2020.
Abbas, to your answer, last year we have a one-off income of about 900,000. And that was the result in the change of accounting principle from accrual to cash basis. So it was one-off. So if we exclude that one-off, our profit would be around 1.4 million. I think that will be the right comparison going forward. So for your analysis, I suggest that you will exclude the one-off and see the normal run rate of our performance. Now, talking about if you compare H1 2021 to H1 2022, you see clearly we have 18% growth in net income. We have 15% growth in fee income, and our operating income overall has grown by 17%. And that is the normal run rate for the company.
Thank you. That helps me. Thanks a lot. I appreciate that clarity. My second question is, this half, you're saying, sort of provisioning run rate, cost of risk coming down. And of course, that's a reflection of how prudent you guys have been over the years, and you've built up enough of a cover. Now, how do I link the provisioning sort of cost of risk that I'm seeing this year to the 80% NPL coverage that you have? Is the management going to be prudent and probably provide extra provision until you reach 100% coverage? Is that the aspiration?
Well, as you know, in our provision is based on the IFRS model, and the base of the provision is well on the tangible security that we are holding under the portfolio. So the coverage that we see currently at 80% is on provision base only. We over and above that, we hold security and depreciated value, which will bring, if you add both the security coverage we have and the provision, we are well above 110%.
Okay, you're talking about the collateral that you have. Is that what you mean?
The collateral, yes. So the net provision is depends on the collateral that we have and on valuations.
Okay, that's okay. I thought as much. But the only impact that I'm seeing, I mean, from what I've heard in the market, and I was talking to some competitors, is that if you have less than 100% provisioning coverage, CBO puts a cap on the maximum dividend payout ratio. They're saying that if you don't have 100% coverage, you can pay only X percentage of profits. Is that correct? My understanding?
No, that is not correct. The correct way is CBO evaluate each and every company, and CBO look at the provision coverage you have under IFRS and under CBO norm, and based on the review they have, then the dividend payout is agreed with the CBO. There is also another regulation that is there. We can only give dividend up to 60% of the profit. That is the regulations. So one, you have to be well provided on the portfolio basis based on the model that you are running. And second, the dividend payout highly depend on the net profits that you generate, and up to 60% you can declare dividend.
Very clear. Thank you.
Yes. Now, when you compare ourselves to other companies, you can see very clearly our provision coverage is we see the second highest. Our leverage is the best among the company. Our NPL overall is showing reductions, and we are refocusing on building back the company and investing in technology, in people, and in overall process and system.
You know, I actually appreciated that because we saw the cost to income. We've been seeing that the management is appointed C-level executives over the last year. Obviously, the benefit of these appointments is not a 1 quarter or 2 quarter impact, right? These benefits are going to play out probably over the next 2 to 3 years. But just to relate that to the leverage that you spoke about, I mean, you know, you have a lot of ample room to grow in terms of, you know, where your loan book can be compared to where it is right now. So low leverage in a downtrending economy has been great for shareholders in the sense that you manage to protect shareholder wealth. But going forward, how do you see loan growth shaping up? Because, I mean, we're looking at $90, $100 oil, you know, looking at projects coming back, a lot of people finding jobs. In that environment, how do you see, you know, either the loan book growing YOY or the overall leverage that you'll be comfortable with, you know, in terms of, let's say, loans to equity over the next 2 to 3 years?
But see, the average leverage in our peer is about 2.5.
Right.
Ours is 0.9. So we have ample growth, and we are very well positioned for growth. However, everything will depend on how the economy grows in the coming years. And we are very prudent in growing the portfolio and ensure that we have a stability in our return going forward. Certain other companies maybe have different strategy where you grow in a difficult time, but it hurts you just in one year or 1.5 years. But we have reviewed, we have the management team, SC, all we are investing is for a long-term benefit and long-term growth of the company. Of course, you not see immediate 1 quarter result because of the investment or the new team member coming. This is a long-term investment in building the clear foundation for our company.
I appreciate that. Thank you. The other question that I had in mind is, you know, you're seeing what's happening around you in terms of other financial services sector. There have been merger plays and, you know, acquisitions in the insurance side. There's been things on the banking side. I feel like leasing sector, in my humble opinion, it's a sector I've tracked for 15 years now. There is room for consolidation. How do you see United Finance possibly, I mean, what's your role? What's your view on consolidation? Do you think the sector is primed for consolidation? And United Finance in the past many years was always in the news in terms of being a potential target. How do you see that story playing out?
You see, Abbas, in the past, United Finance has been the target for merger because they see how is our balance sheet and balance sheet strength and potential profitability that we may have for the company, and also the quality of the portfolio that we have and the management team. Now, the low leverage put us in good positions to look at anything potential. Of course, this will depend on the board of various companies, etc. But at the moment, I think the growth, the FLC sector probably will go for further consolidation. I think so. But everything will depend on how the economy start growing back again. How we see new business, new projects, and new avenues for growing. At the moment, as again, we are just 8 months after COVID. I think it will take another 2 years, 3 years to 5 years to start seeing growth again.
Oh, wow,
and while
wow.
Others have a lot of work in managing their portfolio, we are very much well positioned given our portfolio quality.
Okay, thank you for that. So I think in terms of the current book, you guys are very comfortable with the provisioning or the cost of risk that you're seeing, right? You don't see it going back to last year or 2020. COVID was an exceptional year, but you feel the drop in provisioning or the drop in creation of NPL is sustainable given the current quality of your book. Is that a fair sort of statement from my side?
I think, look, Abbas, the only thing I can tell you, in 2019, our provision coverage was under 74%. Currently, we are just under 80% provision coverage. So we are enhancing our coverage on that sense. We are managing very tightly the portfolio quality to ensure that there's a minimum impact in provisioning. We are carrying over and above what is there, certain general provisions that will give us a buffer in case these customers deteriorate. So we are very well positioned.
Got it. I think my last comment or / question, you've obviously addressed it a few times on the call, is generally when we looked at the leasing sector coming out of 21 and where oil prices are, we expected growth to be a little stronger than we've seen, not just for United Finance, across the sector. Because we were trying to, as analysts, we were trying to see that, that the economy is picking up, there's jobs creation happening, expats, a lot of expats who went back, started coming back into the country. So we were just trying to, it's difficult to reconcile a positive environment with the sort of small little growth that we are seeing on the books of all leasing companies. I think, is it just out of being cautious, given that you've had 5-6 challenging years? Or there's generally...
No, Abbas, I think as an analyst, I think I'll suggest that you do much in-depth review of the economy. Yes, the sentiment is much positive with oil price today. The government has put a fiscal policy and measures to improve the account of the government. They've been repaying the debt, but you have to see that what the benefit that ultimately will come to the market, which is how much comes in the contracting, how much in the industry, how much in import and export, and how much in the overall retail corporate sector. So we are ourselves, when we are reviewing, we have to see a clear growth. But overall, the sentiment, in the economy, sentiment is much more positive. That we see. The government accounts are in much stronger positions today, which will enable the government to start looking how to put more money in the economy. Job creation is very critical for the country. So we are looking at job creation. We are looking at humanizations. So at overall government level, the clear great measures has been taken, and we see that the positive impact will come over the years.
Thank you very much, sir. Thank you for very patiently answering my questions. All the very best to you and your team, and look forward to interacting with you again. Thank you.
Yeah, welcome, welcome, Abbas.
As we have reached to the final final part of our session, if you have any further questions, you can put up here.
So we have 1 hour. We had 1 hour window for the presentation, so we only have 2-3 minutes left. I'll appreciate if there's any further questions from anyone of you guys. There's only 1 minute left. So we thank you so much. Thank you so much for being with us today, and looking forward to have further discussions in the as we publish the other numbers every quarter. Thank you.
Shukran, Nasser and the team. It was a good presentation.